So I think overall we're seeing a little bit more signs of recession pressure. It's been much delayed, and we're still not seeing really acute signs of recession, but the labor market is getting softer. But I think, the actual result is a little bit less narrative driven than that. I think a lot of it is just rebalancing. We've had such a historical bond bear market. I mean, the absolute worst performance since George Washington. Treasuries have never done this poorly, right? So it's been this awful period for bonds. And especially given the multi-month really sharp sell-off they had, it's natural for some large portfolio investors to rebalance, especially on a quarterly basis, to basically lean into the fact that the bonds underperformed and to maybe sell some of their Mag 7 stocks that have just gone straight up. And so I think to some extent, once those yields get that high, they become somewhat more enticing and they help encourage that type of rebalancing. So I think we're seeing some of that. I'm certainly less bearish on bonds down here than I was, over the past few years. I've generally been in the bond bear market camp, but I think that the bond market is still not out of the woods yet. If you look forward, the amount of supply coming is basically just endless, right? So we have like $1.8 trillion deficits and growing as far as the eye can see, with very unlikely ways to address this. If we do get a recession, the interest rate component could relax a little bit, but then other parts of the deficit tend to blow out in a recession. And so there's really kind of no path forward realistically for addressing these deficits. And so I don't really still love the long end of the bond curve on a risk reward trade. I mean, I think it's potentially a tradable asset at these levels. But I think if someone's interested in the bond market, I think the tips are interesting. 5 or 10 year tips are pretty interesting here. Some of the 2-year treasuries are pretty interesting. There are certainly attractive parts of the curve. And I think that's what investors are seeing, that basically some of these assets have become more attractive and have encouraged some degree of rebalancing. I'm very neutral for the next 6 months. Basically that, the sell-off was even worse than I thought, despite being a bond bear. So it exceeded my expectations to the downside within the time frame, at least. So I wouldn't be surprised to see it just, consolidate for a number of months. For me, the long end of the curve right now is just in the too hard pile. There's, as Stan Druckenmiller would call it, there's no fat pitch here, right? There's no easy hit. It's not easy to say if it's going up or down. And so for me, it's just why play in that market when there are other more interesting markets? Whereas on the other hand, I think that real yields on tips, it's going to be hard to sustain them at that high real yield level. So I do think that tips are a more kind of higher conviction, longer term view, and you generally take on less duration risk. So, the 5 or 10 year tips I think are good enough. You don't have to go out longer.
Hey, money talkers, ready for a wild ride through the crypto universe? Today, we're unpacking why the crypto market is skyrocketing, from Bitcoin's triumphs to SEC showdowns and market whirlwind. Let's dive in. Hold on to your crypto hats. Bitcoin's leading the charge, grabbing the crypto market by the horns. On November 15, the market shot up, adding a hopping $110 billion, hitting a $1.4 trillion valuation. And guess what? This ain't just a one-day wonder. It's part of a bullish trend that's been strutting its stuff all month long. Why the crypto party today? It's all about Bitcoin flexing its muscles. Bitcoin isn't just a trendsetter, it's the trend. Accounting for 52% of the entire crypto market, it sets the vibe. Forget traditional assets, Bitcoin's stealing the spotlight. Charlie Morris, the brain behind ByteTree, says Bitcoin's going mainstream and the bear, oh, it's history, my friends. Hold tight. We've got a roller coaster of liquidations. Bitcoin's wild moves triggered a cascade, unleashing the biggest liquidation storm since August 17. Over $307 million in leveraged long positions got washed out in 24 hours. Yep, you heard it right. More than 88,000 traders got caught in the crypto wave. Bulls, bears, and liquidations. It's a crypto thriller. The plot thickens. The crypto market's not just about ups and downs. It's about SEC twists and Bitcoin ETF dreams. There's a buzz around a potential Bitcoin spot ETF. Bloomberg's Eric Balchunas and James Seyfarth are throwing the odds, suggesting a 90% chance of approval by January 10, 2024. It's an 8-day countdown since November 9, with 12 ETF hopefuls waiting in the wings. Will this be the game changer for institutional Bitcoin adoption? Hold on to your moon boots, crypto space cadets. The U.S. economy is booming, growing at a dazzling 5% in Q3 2023. Wages are up and folks are splurging. The crypto market's catching the wave of economic glory. More cash in investors' pockets means a crypto jackpot. And there you have it, money talkers. Bitcoin's ascent, SEC surprises, and the market's roller coaster ride. What's your take on this crypto whirlwind? Now let's continue our discussion with Lyn Alden.
Yeah, we're seeing mixed inflation expectations depending on what you look at. So break evens are not that high, but for example, Michigan survey has showed a little bit of an inflation expectation breakout. My general expectation is, next 6 months, it's really kind of decided between this recession or this ongoing fiscal stimulus. Whether or not recession dies down could be determined by very specific geopolitical events. Like, for example, if the war in the Middle East expands and there's some sort of oil supply disruption, that would send inflation right back up pretty quickly. Whereas if you don't get any of that and you do get a U.S. recession, you could see pretty muted inflation for the next 6 months or so. But my overall longer-term view is that whenever we try to have another growth cycle, so whenever we don't have PMIs going down, whenever we have another reacceleration, inflation forces are still generally there. The very large fiscal deficits, the tight energy supply, the tight labor market. I think that's going to be a recurring theme. So like prior inflationary cycles, it usually comes in waves. I expect that to happen again. So for me, the less interesting call is about the next few months. And the more interesting call is basically just that still don't really like the real purchasing power of long duration bonds here. But tips are interesting because, if you do get a recession, probably real yields come down, which is good for tips. If you lock them in now. If we do eventually get another inflation breakout, tips give you some protection with, basically a real yield above that, kind of CPI. And so it might or might not keep up with quote unquote real inflation. But on a risk adjusted basis, I think it's one of the more interesting places to have conservative capital at the current time, alongside other more direct inflation hedges like energy stocks or things like that. So I still have a generally inflationary outlook in the longer term. And I express that mainly through having tips in energy stocks. And so I expect it to probably inch up higher. I don't think we'll see the levels of unemployment that we saw, for example, in the 2008 crisis. I think in many ways, the 2001 recession is instructive here, which is that, by most metrics, that was a pretty mild recession. I mean, if you just look at the stock market, you would assume it was severe, but that's because equities were in a bubble. When you actually look at, what did GDP do? What did unemployment do? That was a fairly mild recession. And I think because of the tightness in the labor market and the ongoing large fiscal deficits, which are stimulatory, it's pretty hard to have a very deep recession. I don't love the phrase hard landing, soft landing, because I think that somewhat misses the point. I've described it as an emerging market landing. If you look at recessions in emerging markets, they tend to be a little bit different than these disinflationary recessions we're used to in the developed world in the past kind of 40-year structural disinflationary bond bull market. Generally, when you have emerging market recessions, they're more stagflationary. And some of the nominal numbers continue to surprise to the upside. If you just look at what's happening to the economy in their local currencies, things are generally still going up, even as you look at things in dollar terms or gold terms are not doing well. And I think that given the ongoing slow-moving fiscal crisis, I mean, you're running something like 7% of GDP deficits before a recession even starts. It's pretty hard to have a disinflationary recession when there's just outright that much fiscal deficits pouring into the economy before it even starts. That doesn't mean you can't have, kind of an inflationary or kind of stagnant type of economy. And that's why I think it's having experience with emerging market recessions is probably a little bit more instructive for what this could look like. But again, right now the PMIs are showing kind of intermediate. They were starting to bounce. They were starting to show actually kind of a potentially a bottom, almost something you could call a soft landing. But the latest reading has been pretty weak. The labor market's still weakening. And so I think that we're seeing these ongoing forces, so that the Fed's tightness is putting downward pressure on interest rate sensitive industries. So residential real estate, even though the prices have held up, the turnover has stalled. Commercial real estate's under severe pressure. Small businesses are under severe pressure. Basically, any company that has fairly short duration debt that has to refinance, even just by holding interest rates here, that's going to get harder and harder on them because more and more of that refinances every quarter. On the other hand, this is offset by the fact that the U.S. government's in the same position. The average duration of their debt is only about 6 years, and a lot of that is front-loaded. So they go up to 30 years, but a lot of that's like at any given time in the first, kind of year or two. And so they've had to refinance up to these very high interest rates, and someone is earning those interest rates. That money is pouring into the economy in a certain way. And so we're seeing kind of like very loose fiscal policy, which is stimulatory and inflationary. And we're seeing very tight monetary policy, which is recessionary and disinflationary. And they're kind of at like a stall speed right now. So I think that that's probably going to continue for the next quarter or two.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.